Hey guys, JC Peretz here of allstarcharts.com, and I'd just like to welcome you to this special video. Usually this is for institutional customers and our students get access to it as well, but this is really the first time that we actually open it up to the general public. And the reason we're doing it is so that you can get an inside look as to how we start from the top and then work our way down. So we're going to start with a global macro framework. We're going to look all over the world using intermarket analysis and looking at the major indexes from different countries. And then we're going to work our way down to the US sectors and individual stocks that provide the best risk versus reward opportunities. I hope you enjoy it. So let's get the pointer going. And then as always, just as a little reminder, nothing we talk about here obviously should be construed as any sort of solicitation. These are not buy or sell recommendations at all. This is strictly for informational purposes and educational purposes as well is really our attempt. And if you have any questions at all, I encourage you, go to allstarcharts.com/terms and it's all there for you. And we're lucky that this conference call purposely was done after the end of the year, so we can get all of our monthly charts complete and really make sure to include that in our analysis. And I mean, call me crazy, but this looks like a breakout from a 21-month base. I mean, I don't know what to tell you. It seems pretty clear to me. What we just saw here, I think, is very similar to what we saw here. For those of you who have been here for a long time and been watching these conference calls again and again, this was what we anticipated, an upside resolution, which is perfectly normal within the context of an underlying uptrend, which was clearly the case throughout 2016, 2017. Huge bull run, and now we are breaking out again, which is perfectly normal. Remember, these are some longer term charts, so I'm not telling you we're going to, the S&P 500 is going to hit 4,000 tomorrow. I can virtually guarantee it won't. But that is ultimately the target, and for those of you who have been here for a while and remember 2015, when we broke out, we had targets up near 3,000, for a reason, and those were hit, and we had consolidations. Now we have targets near 4,000, right? It's really no different. In fact, a lot of similarities to what we saw after the 2015 correction. And then I really wanted to make sure, I know there's a lot of new members. I guess, I don't know, maybe it's New Year's resolutions. I don't know what it is. We have a lot of new clients around the world. And I just want to reiterate that I really do not care what happens in the market, right? I'm too old for that. I remember in 2008, it was my first bear market. And the entire way down, as bearish as I was very worried about what the implications were for the economy. Oh my God, what if I'm right? And all these banks are going to disappear. The economy is going to be terrible. And I used to really worry about that. I just don't anymore. I can't worry about the implications. We really only have to worry about what's in front of us. So just to reiterate, I don't care if the stock market doubles or gets cut in half. I can't worry about those things. So it doesn't matter to me. Gold can go to zero tomorrow. I don't care. US interest rates, 20%, whatever. It doesn't matter. I don't think about those things. So we are completely unbiased when it comes to what we think about the market. We're literally going to take what the market is suggesting is the path of least resistance, and we're going to go in that direction, right? And we don't care what direction it is. You guys who have been here for a while know, when I think we need to sell all our stocks and start shorting everything and buy bonds and gold, I'll be the first one that's going to be, talking every day about how this is what we need to do. But that's not now. In fact, it's the opposite. What I'm seeing is the Dow Jones Industrial Average telling a very similar story to what the S&P 500 is doing, 21-month consolidation, and now we have had 4 consecutive closes, 4 consecutive monthly closes and new all-time highs, all-time monthly closing highs, 4 in a row. Sometimes, when you read the technical analysis books, they tell you need 2 closes for confirmation. I don't know what the right answer for that is, but I think 4 is a safe bet we've broken out. And like I've been talking about on the blog and the emails that I'm sending you guys, I do think that we are much closer to the beginning of a new bull market than we are towards the end of an old one. And then a big pushback I get, well, JC, the Dow Jones Transportation Average hasn't broken out yet. It's like, all right, well then don't buy transportation stocks. Right? Yeah, I don't know what to tell you. I mean, this all the last 6 months, everybody's like, well, the percentage of stocks above their 200-day moving average is only 40%. It's like, well, buy the ones that are above their 200-day moving average if it means that much to you, right? So I really think that for this sort of thing, I think it really depends on what your perspective is. Mine has been that, sure, yeah, we do want to watch the Dow Jones Transportation Average, obviously, but just because it's not making new highs doesn't mean we need to short everything. right? In fact, I'm in the camp that we are about to break out. I think we get it any day now. I think it's coming. So I'm pretty confident that we'll see a new all-time highs in the Dow Jones Transportation Average very, very soon. And with that being said, if the Dow Jones transports are going to start to outperform, this would be a perfectly logical area for it to do so. It's where it started to outperform in the summer of 2012, which, as you guys recall, was when interest rates bottomed. So that's very, very interesting. And notice how interest rates put in another bottom around this time. So I don't know. Maybe that has something to do with the rates. Maybe it doesn't. But if transports are going to start to outperform, this would be a logical place for it to start. And meanwhile, the utilities keep making new all-time highs. Remember, like in the spring, guys, in the summer, everybody was like, well, JC, the only sectors making new highs are the defensive areas. My argument was they weren't so much the defensive areas as they were the higher dividend paying areas with interest rates getting slammed. And the fact that utilities were making new highs is not a negative. In fact, if you guys recall, I was overlaying the S&P 500 over the Dow Jones utility average, and they look exactly the same. So utility stocks going up is consistent with stocks overall going up. So just wanted to reiterate that. NASDAQ composite, new all-time highs. What else is new? As we've been talking about for a long time now, the relative strength out of the NASDAQ, it's very clear that the exposure to technology in the NASDAQ and lack of energy for that matter is a big reason why we're seeing that outperformance. So really nothing new. We've been seeing this for a while. And then getting back to the Dow Jones Transportation Average, that really comes to the Dow theory, right? When the industrials make new highs, transport should be making new highs as well. I think that, I have this conversation all the time with friends. I've written blog posts about it and made some videos. If you can't find them, email me and I'll send them to you. But, the argument is, are the semiconductors the new transportation stocks of today? Because we don't use railroads anymore. And, the method of transporting our goods and services is through online, right? So those are semiconductors, and I don't really have an answer. I think my good answer is let's look at all of them because we've seen divergences in the past. Like look at semis in 2007, 2008, really diverging with transports, for example, and semis were a good heads up when transports were not, right? So I think the good answer is let's just look at all of them. Another pushback I get, JC, the Russell 2000 is not making new all-time highs yet. So that means that the stock market's about to crash. And, I like the transports. It's been one of those things where we're not just going to start shorting everything because this one index or these two indexes have yet to make new all-time highs. I mean, that's not really fair. And quite frankly, in a similar way that I think that the transports make new all-time highs, I think the Russell 2000 small caps go on to make new all-time highs very, very soon. In fact, we've only had, if my calculations are correct, 1 month in history that has been a higher close in the Russell 2000 than yesterday or than 2 days ago. One higher close ever. So I mean, if you're shorting stocks because the Russell 2000 hasn't made an all-time high yet, I don't think that's a good reason personally. Meanwhile, mid-cap 400, new all-time highs, just continues to rock and roll. It has now joined the party. And if you guys, as I've been pointing out for months, the list of sectors and indexes and stocks making new all-time highs and making new 52-week highs continues to get longer, right? It's not, the list isn't getting shorter. So the whole deterioration of breadth stuff to me has been wrong, continues to be wrong. Not only are we not seeing deterioration of breadth, it's been the opposite for months. Again, nothing new. This has been going on since the end of the summer. Expansion and participation, no doubt about it, not contraction. Listen, if we're looking at microcaps versus the mega caps here, so the microcap index versus the Dow Jones Industrial Average, and listen, if small caps are going to start to outperform, again, this would be a very logical place for it to do so. This is exactly where they bottomed in March of 2009, which is, as you recall, was the beginning of a very bullish time for stocks. So that's something that we'll be watching. Looking broader, here's the S&P 1500. So this includes the large cap S&P 500. It includes the mid cap 400 and includes the small cap 600. Right. So there's a 1500 stocks breaking out of a year-long base to new all-time highs. What's there not to like? This is not a reason to be shorting stocks. This is just further evidence of what I started out the conference call with, that I believe we're near the beginning of a new bull market, not near the end of an old one. As you guys recall, over the last probably 3-4 conference calls, I've been showing this exact chart, the value line geometric index, and suggesting, was this a failed breakout and we fall apart? or just a breakout from a 22-year base. And it's looking more and more like the latter, a breakout of a 22-year base in the value line geometric index, which is more of the median move for the stock market. This one comes from my friend Ari Wald. I hate stealing charts from my friends, but I have smart friends, so I got to take some sometimes. Especially, I think this one proves my point. Here we're looking at the percentage change in these bull markets, and here we're looking at the duration. And 2018 is really probably the shortest and weakest bull market of all time if it were to end tomorrow. So, I think what this chart really shows is that there's a higher likelihood that we're near the beginning of a bull market, not near the end one. This one shot out to Ari Wald at Oppenheimer. Good guy, really, really smart. So I took this one from him because I wanted to show you. So thanks, Ari. Here we're looking at the global Dow, and I decided a little over a month ago, this was my favorite index in the world. So I think it's really well weighted. If you can't find the weightings, email me and I'll send them to you. But the weightings globally, I think, are pretty consistent with how I think they should be weighted. And this is a chart that I would be buying 100 times out of 100. If we're wrong, then we're wrong. But man, this is this is when we want to be buying, not when we want to be selling. And the global 100 index keeps making new all-time highs. That's 4 months in a row. Nothing new here. We've already been seeing that. Still think we're going above 58. A lot of people laughed at me when I said that Earth was breaking out to new all-time highs, but they was. And Earth is just the ticker symbol that they cleverly came up with for the MSCI World ETF, new all-time highs. So anywhere you want to look at it, Global Dow, Global 100, MSCI World ETF. I got a couple of more indexes I'm going to show you at the end of this conference call globally to kind of put the exclamation point on what I'm trying to get across in this call. But needless to say, we're heading higher. Financials, all-time highs, really just flirting. Whether this is it or not, maybe a couple more weeks of consolidation. I don't know if this is it or not, but man, if financials are really able to break out to new all-time highs, and I think they are, I think they will. I really do. I'm pretty confident that you'll see financials, and we'll be talking about financials making all-time highs 4 months in a row, 3 months in a row, something like that at some point this summer or maybe late spring. I really, really do, and I'll tell you why. First of all, here's a closer look at financials. This 31 level is really the one. When you see a 31 handle and it holding that 31 handle, I think that's your breakout. Here's a closer look. I was taught we want to be buying smiley faces, not frowny faces, and this is like a smiley face to me. And then remember, the biggest component of the XLF is Berkshire Hathaway, which I think gets forgotten quite often. And we are now breaking out of a, man, how long is this base? This thing's going for 24 months or something like that. I mean, long, long base. And we are now breaking out to new all-time highs in the largest component in the XLF. And remember, the reason, they own a ton of insurance and a lot of Wells Fargo, which is probably why it's been an underperformer, because it's owned so much Wells Fargo. Goldman Sachs is back. We're back above the neckline from that head and shoulders top. If you guys recall how bearish we were in the fourth quarter of 2018, a lot of that, or some of that at least, had to do with this massive topping formation in Goldman Sachs that obviously completed, reached our downside objectives, and now we are back above that key level, which the 2015 highs. It really reminds me a lot of the German DAX. Really, you guys who have been around know that I've been talking about the 2015 highs in the German DAX. We'll get into it in a minute. And, I was saying, listen, if we're above the 2015 highs in German DAX, I mean, how can we not be buying stocks? And I would treat Goldman Sachs in a very similar way to that German DAX, that 2015 highs. If we're above that, call it 219, 220. Hard to be bearish stocks. So let's talk about why I think the XLF is going to break out. Here are a few reasons. First of all, regional banks held their 2007 highs, as we said they needed to, and are now making new 52-week highs in the regional banks. Broker dealers and exchanges are making all-time highs, again, holding above the 2007 highs. JP Morgan continues to rip. I think we see 169. We're about halfway to that target now. I really like this ACGL, Arch Capital Group. Nice consolidation above support from a more conservative standpoint. We want to be long if we're above 40 with a target just under 50. If you want to be a little more aggressive with stops, let's call it 43 and only be long if we're above 43 with a target up near 50. So it really depends on how tight you want your stops. If you want to get a little more room, 40 bucks looks good to me. Let's talk about insurance. Here's the IAK. Is it like this? Or is it like that? What do you guys think? We break out to new all-time highs, or we break down. If you guys recall, several months back, I was showing a very similar chart to Microsoft. Looked exactly like this, right? And I was like, all right, which one is it? Which one is it? Because I think it's going to have big implications when it comes to technology. Well, this I think is going to have big implications when it comes to financials, because it's really been one of the leaders for sure. I think it's like this. I think we got a breakout, not a breakdown. So I think it's this one. So that's me. Let's talk about within insurance. The reinsurance stocks continue to win. I get people tweeting me and stuff. They're like, JC, weak breath. It's only tech stocks that are going up. And I'm like, are you guys like looking at your charts upside down? Like, what do you mean only tech stocks? Here we're looking at the reinsurance sector. MMC continues to be an absolute beast. New all-time highs. I still think we're going to 150. We want to be long if we're above 100, but I do think we're going to 150. Willis, another reinsurer, making new all-time highs. This group is hot. Look at Aon. I mean, I shouldn't say it's hot. It's been working for a long time, but continues to work. I should say. I shouldn't say it's hot. It's been hot. It's been moving. On the Cincinnati financials, also I really like this pullback. So we broke out, ripped right through that 100 level. We now coming back. If we're above 101, we want to be long Cincinnati financial with a target near 152. And then here's really the chart as why I really think that the XLF, which is the U.S. Financials Index, of which Berkshire Hathaway is the largest component. Then you got some JP Morgan and Goldman and all that stuff too. Look at U.S. broker dealers above the 2007 highs, making new all-time highs. Regional banks above the 2007 highs. Insurance above the 2007 highs. All three of XLF's little cousins retested those '07 highs successfully and are now moving forward. So I think it's inevitable for the XLF to do the exact same thing. And then let's not forget the financials reimagined. You know, a lot of you guys, myself included, think that the way that the XLF is constructed is pretty stupid. But Standard & Poor's doesn't care what I think. Is it even Standard & Poor's who does the S&P? I don't even know who it is. Whoever it is, they don't care what I think, as they shouldn't. But I do think it's pretty stupid. So I really like this financials reimagined index. It's low, super low liquidity. I mean, I would personally really wouldn't touch it. I look at it more for informational purposes and look at the top 10 holdings: MasterCard, Visa, PayPal, American Express, Intuit, Square, Fiserv, FleetCor, WorldPay. These are the types of stocks that I have been working. And you can call them financials or not. You know, the truth is a lot of them are tech. That's why they look like tech. But needless to say, really an interesting group at that GFIN. Communications making new all-time highs. This is the new sector, guys, where basically half the entire thing almost is just Facebook and Google. But so we're making new all-time highs coming out of this base. Part of my argument this summer that it was not defensive rotation and it was only Utes, REITs, and staples was that communications were also pushing up against new all-time highs, and Google and Facebook are not defensive areas. Google new all-time monthly closing highs. We still love it. I still think we're going to 1800. Nothing's really changed. You know, you guys have heard it before. We want to be buying smiley faces, and we're making new highs as we should. I still really like Google. I think we're going a lot higher. Facebook new all-time monthly closing highs. I can't stress enough how important it is to recognize that the most bullish thing a stock can do is go up. And journalists and fundamentalists and economists, they get mad at me when I say that, but it's true. There's nothing more bullish that a stock can do than go up. And Facebook closing in new all-time highs, I think, is consistent with much higher prices for communications. If you remember, I don't know what I don't know. The angry journalists were writing something. I think that they were selling people's data or something like that. There were like criminal trial. I don't know if they were criminal trials, but like there were like congressional hearings or something that people actually watch, believe it or not. I don't know. The point is sentiment was really, really bad. And here we are pushing up against all-time highs. Kind of reminds me of Tesla, which we'll discuss in a minute. When journalists try to make it about themselves instead of about what they're supposed to be writing about, there's something interesting going on there. We've seen a crazy squeeze in Tesla, which has been beautiful to watch, of course. And Facebook, I think we're seeing something similar. So we want to be buyers of Facebook, nothing new. If you guys can't find the trade, actually go to the trade ideas page. It's listed there. Sean put up an options trade as well if you want to take advantage of it like that. Comcast also in that communications group, I think looks great. Want to be buying that smiley face, right? If we're above 40, got to be long. I think we're going to 59. And then the Dow Jones Internet Index has been a really interesting one because there's some of these companies, I mean, have massive, massive market caps, right? Amazon, Facebook, Google, right? Huge, huge market caps. So really, really important index that we want to be watching. And listen, if we're above 130, we got to be long, whether we're long the ETF, FDN, Frank David Nancy, we could be long the ETF, we could be long some of the components in the internet, both. I mean, either way, I like the group. I think we have to like the group. And we'll talk about Amazon in a minute. Here's Tencent. There's a over the counter ADR that you can own Tencent, but I do want to do the analysis. Price in Hong Kong dollars. So the way it looks to me, this looks like a breakout, right? So if we're above 350 in Tencent priced in Hong Kong dollars, we want to be long the ETF. Excuse me, not the ETF, the ADR. I think the ADR is right around 50 bucks, 49 bucks, something like that. All right, so and if you can't find it, email me. All right, so here's Amazon. I've been writing about it. This is really just a reverse engineered trade. So I just want to reiterate why it is that we're so long Amazon. First of all, it's in an uptrend, in case you hadn't noticed. But it's really been left for dead. I mean, it's amazing what 18 months of sideways consolidation can do for sentiment in a stock. I mean, people seem to hate this thing. They forgot that this is literally one of America's greatest stocks ever, right? And I think sentiment, as people have just forgotten about it. So it was basically a reverse engineered trade. It's like, listen, we think stocks go a lot higher, S&P going to 4,000, Dow 40,000. I mean, these are really the targets that we've got. So if that's the case, consumer discretionary is probably not going to sell off and get crushed in that environment, right? Consumer discretionary is going to at least participate. We're not even asking for outperformance, just somewhat kind of participation. Fine. I think we can all agree with that. Stocks are going up. Discretionary's got to at least participate. Well, 22% of discretionaries is Amazon. So, if the market's going to do well, Amazon mathematically has to do well. So here's consumer discretionaries versus consumer staples, right? So this is basically what the long only community is pricing in moving forward for the market. Remember, the long only mutual funds, the way they get their pretty little bonuses at the end of the year is by outperforming their benchmark, the S&P 500. So if they think the market's going higher, they're going to overweight discretionaries, underweight staples. They think the market's going to sell off. They got to overweight staples, underweight discretionaries. I think that's exactly what's happening here. And I think discretionaries are about to break out on a relative basis because they are already breaking out on an absolute basis, new all-time highs in consumer discretionary, which is very consistent with stocks going a lot higher, which we do think stocks go a lot higher. So what did we say a couple of weeks ago? We said, well, if discretionaries are going up, Amazon's got to go up, right? We just sent this out on the 17th. And this is what it looks like now. We're getting those breakouts. So I think it makes perfect sense. If stocks are going up, discretionary is going to do well. So is Amazon. And I think Disney does too. I think this is a good level from a risk versus reward. If we're above 144, because listen, if we're not above 144, this isn't something we want to own, right? We want to own something that's moving, something showing positive momentum. If we're not above 144, I think there's a lot of opportunity costs. I think there's a lack of momentum. I think there's downside risk. But 144 is that level. If we're above that, we want to be long with a target near 180. All right, so here's Tesla, new all-time high. So, I don't read what journalists have to say ever. I mean, it could be great. I'm never going to read it. I just assume it's gossip, whether it is or whether it isn't. That's just the assumption I always make. But I do know, I was seeing the headlines at the very least. The journalists were angry about something. I don't know what they're so angry about. And here we are making new all-time highs. So just from a risk reward standpoint, I think the bet that we want to make is that Tesla just broke out of this monster multi-year base, right? And if we are above 384, I think we can make that bet, right? That's the bet we want to make. If we're not above 384, I can't make that bet, right? So that's really it. I mean, it's not the cleanest chart. But man, the one thing I do know is that from failed moves come fast moves, and these moves tend to last a lot longer than most think, particularly when sentiment is so skewed. It's a messy chart, but if we're above 384, I think we could be long with a target near 535. All right, so here's in the consumer discretionary space, home builders have reached our upside objectives, which were the 2018 highs. Here we are, and we've gone nowhere, absolutely nowhere for months. So markets can consolidate their gains near resistance in one of two ways, right? Either through time consolidation or through a downside price correction. And so far, home builders are showing a lot of resiliency near these levels. So man, if we start to see, a 47 handle in the XHB and we start breaking out, that's going to be very, very impressive. I don't know how long it's going to take. I don't know if we do see some, well, at least some kind of sell off and then we break out. I'm not quite sure how that's going to work out, but definitely something worth watching. And then here's the other ETF. This is the home construction ITB. The components will be different, so you'll want to check that out. But again, very similar, got to these former highs and is really consolidated sideways. So definitely check that out. Further in the consumer discretionary space, a couple of restaurants, quote unquote restaurants. They're more like little joints, but either way, let's call it a restaurant. 87 bucks. If we're above 87 in Wingstop, we want to be long with a target near 127. And what about Domino's Pizza? One of the greatest performers of any stock out there. Domino's, what a beast. I really like this consolidation over the last couple of years. I think ultimately we do break out. If we're above 300, we can get going on this thing with a target near 350. I think we can be patient. I don't necessarily know that the breakout's coming tomorrow, but if you want to put something on your screen for 2020, I think this is definitely one. All right, so here's an important chart, guys. I've been talking about how this is really one of the most important charts that we have in our arsenal right now, and this is this is consumer staples relative strength upside down, right? So the numerator is the S&P 500, the denominator is consumer staples. So as you can tell, we've had great uh, heads up in the past, right? Notice the lower high in 2007, right at the market peak. We got the same divergence in 2015, right before the market peak. We got the same divergence in the fourth quarter in 2018, right as the market peaked. So a breakout here, which is basically a breakdown in staples on a relative basis, is really confirming the new highs we're seeing in the S&P 500. So further strength in this chart down here, which means relative weakness, further relative weakness out of consumer staples, is consistent with higher prices. If you're one of these end of the world people that you think the stock market's about to crash and this is a big bubble and the Fed and the Trump and all that stuff, if you're one of those, you want to see new lows in this ratio, right? Which would mean new highs in consumer staples on a relative basis. That's what that means. So if you're gloom and doomer, that's what you're looking for. I just think that the path of least resistance continues to be higher, which means relative weakness for consumer staples, which again is consistent with much higher stock prices here in the United States and globally for that matter. Here's a closer look at S&P versus staples making new highs, right? So, new 52-week highs in this ratio. There's nothing really bearish about that, at least not yet. So we'll keep an eye out. So now I'm not just all Mr. Happy rainbows and butterflies. Like I tell it like it is, and the MLP. One of the interesting parts of having institutional clients, and some of our clients manage a lot of money. Like these guys are like, oh, JC, you like oil? How much you like it? I'm like, oh, not that much. No, these guys are really swinging. We got some really big accounts, and one of the benefits from that is that I get to have these conversations. They're like, hey, JC, what are you looking at? What are you seeing? Oh, I'm seeing this. What are you seeing? Oh, I'm seeing, so it's good conversations. And just, the rumblings out of Greenwich, Connecticut have been, there's some big size on the short side of the MLPs. It's not for me. I'm just really kind of sharing that information. It's not a trade I would put on, but there's big size in this. So if we're below these former lows, let's call it 860, to be short this particular index. I'm not really sure what the borrow cost is. If I had to guess, it's probably pretty high. I haven't even looked into it myself, to be perfectly honest. But anyway, I'm still kind of somewhat fascinated by this particular situation. The rumblings I'm hearing out of Greenwich, big size, short these MLPs. So if they're wrong, we could see a major squeeze, and I think that'll happen if we're above 860. But if they're right, we could see a major sell-off. But either way, some volatility and definitely some opportunity. So I wanted to point that out. I keep getting asked, JC, are we going to finally get the rotation into energy? The sexy answer is yes, but the real answer is there's no evidence of that just yet. Here's the XLE. We're down here below, near former support. Fine, right? Bigger picture, look at Chevron. Couple of false starts, right? Trying to break out above 130, failed twice. Now we're just hanging in there. I think ultimately we do break out. I think it's coming eventually. But I would have told you that a year ago and we still haven't broken out. So, or I probably did tell you that a year ago and we still haven't broken out. So same thing I told you a year ago, keep an eye out, keep it on the radar. At some point it'll break out, I think. And you know, and we'll have plenty of time to get in. I mean, this thing's like a monster. It's like moving a mountain. This is such a large market cap stock. So put it on your radar, similar to Domino's Pizza. Schlumberger, on the other hand, you know, here we're looking at oil services. From failed moves come fast moves in the opposite direction. Listen, if we're above 36, you know, you want it to punt long with a target up near 60. I mean, that could be that could be a serious game changer in terms of percentage returns. I mean, a trade like this can make the year. You know, take a shot early in the year. I don't have a problem with that. I've liked it above these levels the last several months, ever since this potential failed breakdown. We're above those former lows, right? That's the idea. If we're above former lows, I think we could be long all day. You know, I don't think it's going to be a straight shot to 60. I think it'll probably be pretty messy. But nonetheless, the risk versus reward, I think, is there. You know, this could be March of 2009 for the S&P 500. We could be in a very similar situation now in SLB. The chart looks pretty similar as well. Doesn't this look like the fall of 2008 in the S&P 500? And then we rallied into Thanksgiving, rolled over again into February, March, and then we got the ripper. I mean, man, we could this could be a very similar situation. All right, so Oni Oak has really been hanging in there. I mean, just think about that, just sideways this entire time. You know, what's there really not to like? If we're above 72, I like it long with a target near 104. And then this is really the chart that I want to make sure everybody notices. All right, Jim. Jim got in on the SLB in October. Good for you. Just be careful. Bigger picture, because energy is still underperforming the S&P 500, right? We're still seeing new lows. So, you know, I get asked, JC, is the rotation starting? And my answer is no, it has not started. Quite the opposite. The trend is still down. I mean, I don't know what to tell you guys. Trend's still down. Nothing has changed. And then just take a, this is a great chart, in my opinion. We're looking at crude oil on top and then energy on a relative basis below, just to show you guys that crude oil doing well does not mean that energy stocks are going to outperform. I mean, just look how nasty this relative underperformance has been with oil making higher lows. I mean, just you know, throw what the economist and the school teacher told you. It's just not true. Oil going up apparently has nothing to do with energy outperforming or underperforming. So just keep that in mind. And just to reiterate, I think it's quite obvious, but crude oil is definitely the stronger area of the two between energy stocks and crude oil. Here's crude oil breaking out to new highs on a relative basis. So just an interesting ratio when you're asked the commodity or the stocks. In this case, we'll choose the commodity. And then listen, crude oil and the S&P have not always been correlated. Sometimes they're negatively correlated throughout history. Some usually there's zero correlation, but you can't argue with me that they've been moving pretty closely together over the last several years. You know, so if the stock market is going higher, we should expect oil to go higher as well, unless you're betting on this decoupling, which is also a possibility. But I do think it's definitely worth watching for sure. And then when you ask me crude oil or natural gas, again, crude oil wins again. You know, new multi-year highs in crude oil relative to natural gas. I'll never forget when this bubble peaked. Man, I'll never forget it. It was a special time for me. It was a good trade for us. It was a great trade for us. It was man, I'll never forget it. 54-1, crazy. All right. And again, getting back to breadth expansion, not deterioration. Here's another great example. Healthcare breaking out to new all-time highs 2 months in a row. New all-time highs in healthcare. Medical devices have been the leader there for a long time. No reason to think that that has changed. You know, in my in my humble opinion, a big reason why the medical device stocks keep ripping and keep leading healthcare is because they're not even healthcare stocks. They're tech stocks. They're just hiding, you know, they're stuck in a healthcare body, but they're tech stocks. That's why they look like tech stocks. And then speaking of tech, you know, when I get asked, JC, what's going to take the S&P 500 to 4,000? What's going to take the Dow to 40,000? You know, 38,000? What's going to get us there? I think it's technology. You know, when you compare technology to the rest of the S&P 500, we are nowhere near those 2,000 highs. We're nowhere near there. We're halfway there. You know, so what's going to take the market higher? I think it's technology will continue to drive stocks higher. Man, we are nowhere near those former highs in tech on a relative basis. I think that's where we're going. The people who tell me that it's only a few stocks that are leading this market, I will show them the equally weighted semiconductors index making new all-time highs virtually every single day. See what I did there? Virtually every single day, semiconductors are making new all-time highs. So I am not, this is the equally weighted index, so I'm not buying the deterioration of breath. Microsoft now 1, 2, 3, 4, 5, 6, 7, 8, whatever it is, 8 um, all-time monthly closing highs in a row. The trend is up. This is a monster market cap. I believe it's the biggest company in the world right now. Maybe it's Apple. I don't know. I still think we're going to 205. Just an absolute beast. What else can we say? Texas Instruments, I've liked it. We wanted to be buying this smiley face. Kind of reminds me a lot of the broker dealers above the '07 highs, right? I still think we're going to 153 in Texas Instruments. Here's Booz Allen Hamilton, BAH. I really like this consolidation. It reminds me of Microsoft several months back. If we're above 67, we want to be long BAH with a target above 100. All right, look at China making new highs. Wait till we get to the international stuff. There's some pretty funny stuff going on around the world. But look at China. These are the A shares. To me, they're going higher. We'll talk about the Chinese internet stocks in a minute. The new index, we're making new highs today. Big day today. So here we're looking at KWeb. These are the Chinese internet stocks. We laid it out in 2 months ago exactly in early November. The internet stocks we like, they continue to work. So here we're looking at the Chinese Internet Index relative to the S&P 500, below all of this former support. Man, if we start getting above these levels, we can get a major, major squeeze in the Chinese internet names. And to me, that is evidence of risk appetite for equities, not risk aversion. Here's the Tao Education Group, TAL, about halfway to our target, up near 54. Here's Alibaba. As long as we're above 206, we want to be long Alibaba, BABA, if we're above 206, with a target near 253. Here's NetEase, NTES. I still think we're going to 377. We want to be buyers of any weakness down towards 286, but I think we're going to 377. Here's CINA. So 32 is the big level. That's where we found support in 2010. That's where we found support in 2015. That's where we're finding support again over the last month. And if we're above 32, we want to be long. I think that, man, this could be a three-bagger, no problem, get back up towards 120. So I really, really like the risk reward in CINA. Industrials traditionally have the highest R squared of all of the US sectors. So it's the highest correlation with the overall market of all the US sectors. So making new all-time highs in the XLI is consistent with a lot of the other things that we're seeing, right? Stocks are going higher. And then just to reiterate, we talked before, if the transportation, remember, all the stocks in the Dow Jones Transportation Index are in the industrials sector, FYI. So if the transports and the industrials are going to start to do well, this would be a perfectly logical place for it to do so. The 38.2% retracement of the entire rally from 2020 to 2014. And man, if we hold, we can really get going. So this is definitely a chart we want to keep a close eye on. If transports are going to get going, man, this would be a very logical place for it to do so. And if they do get going, we want to be buying this breakout in expediters. If we finally break out, how long have we been waiting for this breakout? If we're above 78, we want to be long. I think we're going to 111. Honeywell, I really like this consolidation. If we're above, I mean, listen, originally we wanted to be long if we're above 158, 170. At this point, if we're above 177, really keep stops a little tighter. If we're above 177, I like this with a target near 195. SAIA Trucking Company, if we're above 88, I want to be long with a target near 140. This is part of what we call the Dow Next 50. I study Indian stocks very closely. I have a lot of friends in India. I travel to India as much as I can. Shout out Mumbai. And, they have this thing called the Nifty Next 50, which are the next 50 stocks after the Nifty 50 that are part of the Nifty 100, right? So we have the Dow Jones. We don't have that in America. So I was a little jealous. And I said, well, let's just build it. So this is part of the what we call the All-Star Chart's Next 50, which includes the next 30 industrial stocks and the next 20 transportation stocks. This would be on the next 20 Dow Jones Transportation Average, if you will. So I really like this one. It's been a leader for a while. If we're above 88, we want to be long with a target near 140. ITW, Illinois Tool Works. I really like this breakout. If we're above 173, if we are not, I think that there's downside risk. I think there's opportunity cost. I think that puts us back in this range. So not something we want to own if we are not above 173. But if we are, I like it long with a target near 265. Here's JCOM, J2 Global. To me, this looks like a breakout on a retest, right? What do you guys think, right? Resistance, 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 resistance again in 2018. Resistance a bunch of times last year. We broke out on a gap higher and now retesting it. You know, what else can we ask for? If we're above 91, I like it long with a target near 107. Further in the industrials, Caterpillar making new highs, obviously to me, suggests that emerging markets are going to continue to do well. We're not seeing any evidence that we're going to start to see outperformance out of emerging markets quite yet. I mean, I'd love to show you guys a chart of EM outperforming, but it's just not there. You know, I'm not going to push it, just, you know, it's just not there. So, but nevertheless, if stocks are going a lot higher, emerging markets are going to at least participate. They don't necessarily have to outperform. Caterpillar making new 52-week highs, I think is consistent with EM going higher as well. I don't know what happened here with this typo, but here we're looking at the agribusiness stocks, ticker symbol MOO. I apologize for this. I don't know why it did this. But to me, this is finally breaking out to new all-time highs. I mean, I've been waiting for this for a long time, finally this to break out, and I think it's doing that. I really do. So here's a closer look. If we're above 68, I like it long with a target near 85 on the MOO. If you're looking for the ETF, if you're looking at for some individual names, I like the Deere. I think Deere goes to 208. We want to be long if we're above 175. I think we see 208 on the Deere. Look at Zoetis. Zoetis, first of all, let's remember what Zoetis has been doing. Zoetis is an absolute beast. So let's take a closer look, and we want to be buyers of this breakout. I think we go to 139, then ultimately 154. But we only want to be long Zoetis if we're above 130. So this is just from a tactical risk versus reward opportunity. Considering what it is doing, it is an absolute monster. The strongest stocks. RSI doesn't get below 50 in the strongest names. It's very rare, but that's what we're seeing. So momentum is super strong. The trend is up. The sector itself is about to break out. So we want to be in the leading names. Tyson Food is another one of those leading names in the agribusiness space. If we're above 89, we want to be long TSN. If we're above 89, with a target above 140. All right, so everybody's asking me about the precious metals. JC, is this it? Is this it for gold? Is this it for gold? You know, I've been in the camp for a long time that, you know, this is, you know, what we call the Kardashian bottom in gold, right? Nice big bottom with explosive resolutions, right? And I think that's what this is. And I think we do retest those former highs, right? I do. And then we go beyond. I mean, we have some. This could be this all over again. In fact, I do think it's this all over again. I do think it's 2000, 2001. I think that's what's going on here. But I do think it's going to take some time. As you guys recall, in October, as bullish as we had been since 2018, as bullish as we had been gold, it was like, listen, our targets have been hit. We're selling gold, right? This was on October the 7th. And the idea was all of this former support in 2011, 2012 that ultimately broke down. This is our first test of that. So why do we have to be in such a rush to get into gold? In fact, it was the opposite. We want to be taking profits, right? We want to be selling gold, at least for the time being. And then ultimately, when we get above 1570, 1580, we'll have plenty of time to get into this thing. And in the meantime, you know, if you just want to get chopped up, have a ball. And guess what? If you've been in this thing since September, all you've gotten is chopped up. So, you know, for me, I still, as bigger picture, as bullish as I might be, bigger picture, tactically, it's still a no touch. By the way, commercial hedgers are adding to their net short positions. Commercial hedgers have on their biggest net short position ever. They're not covering their shorts, they're adding more to them. And if you guys recall, and by the way, don't give me the whole gold hedgers are always short. Yes, they are always short. But they've never been this short before. And by the way, in September of 2018, they were not short. Actually, they were actually net long. Check my math, but maybe for the first time in history, they were net long, and that was part of the reason why we're so bullish of gold. And now it's the exact opposite scenario, and we're below overhead supply. So if you want to get chopped up in this thing, have a ball. It's not for me yet. Let it break out. Why do we have to be in such a rush? Same thing with gold miners. Every time it gets to 31, it sells off, sells off, sells off, sells off. So here we are, still stuck below 31. The market has not proven that demand has been able to absorb all of that overhead supply. So let it. Why do we have to be in such a rush? That's how I see it. Here's going to be a big. This is going to be an important chart this year, guys. I really do. This is the S&P 500 relative to gold, right? So this is stocks versus gold. This was support that broke down, turned into resistance, and then we broke out again. Is this just a successful retest, or is this going to be a nasty failed breakout and stocks are going to fall apart relative to gold? You know, I'm not convinced that that's the case yet. To me, this still looks like an uptrend to me, stocks over gold. And I'll show you some other stocks versus gold charts in a minute. Silver, a bigger picture. Again, I do think that this is structurally the beginning of a new bull market in silver. I really do think that. But we're still stuck below overhead supply. And silver is the underperformer, which, by the way, is very, very critical. If precious metals are going to do well, silver is going to see some outperformance. And we just have not seen that. Right. So I think part of the JC finally gets bullish again on precious metals, the things that we need to see: silver outperforming, GDX above 31, gold making new highs. I'd like to see that commercial hedger position not be as obnoxious as it has been, right? Those are the things we're looking for. In the meantime, we're going to be patient. Here's a look at Swiss francs. This is basically the dollar story, right? If the dollar is going to fall apart, Swiss francs obviously going to do well, and that traditionally is good for gold. They look really exactly the same, right? Swiss franc and gold. Now, on the other side of the coin here, we're looking at base metals. Commercial hedgers had on their largest net long position in history. They started to unwind it, but obviously copper continues to do very, very well, hitting new highs. We haven't seen these levels since last winter. We continue to do very, very well, which I think is part of the interest rate story, which we'll discuss in a minute. And Freeport-McMoRan, we liked it if we were above 10. Here we are at 13. That's 30% pretty quickly. These are the kind of moves you get with stocks like these. So I think it's important to remember that the sort of beta you get with these guys. I still think we're going to 20. That hasn't changed at all. So here's something we haven't seen for a while: metals and mining breaking out of downtrends, coming out of basis. Haven't seen that in a while. Here we're looking at the metals and mining relative to the S&P 500. Again, doing things we haven't seen it do in a long, long, long time. I think it's worth keeping that in mind. And, some people out there are like, well, JC, why should I care about copper? And the reason you should care about copper is because they look exactly like emerging markets, literally tick for tick. So even if you're never going to trade a copper future in your life and you're scared of the beta of Freeport-McMoRan, if you are in emerging markets at all, which most of us have some sort of exposure or are looking to put on exposure or looking to take off exposure, whatever it is, either way, emerging markets are important to a lot of us. Even if you're never going to touch a copper future, I think both of these are going higher, right? That's the bet that we want to make. Now, here's an interesting sort of look. Here we're looking at gold versus bonds, and we're looking at gold versus stocks. So this is like really gold on a relative basis, and here we are breaking out relative to bonds. So to me, if you're going to be asking me, JC, gold or bonds, I like gold over bonds. I'm not quite convinced that it's gold over stocks yet, right? Gold over bonds, sure. Gold over stocks, I'm not quite convinced yet. Here we're looking at gold versus the NASDAQ. To me, this is a downtrend. I mean, I don't know what to tell you guys. This is not an uptrend. This is, when I see this chart, I don't start saying, oh yeah, let's buy this one. No, this is probably on the sell pile, right? Here's a closer look at that. To me, this is a downtrend. I mean, there's nothing here that suggests it is trending higher in any way at all. So I can't get behind. Buying gold and selling stocks. I can't get behind that yet. Here's silver versus the NASDAQ. Again, downtrend, right? Does not look like an uptrend to me. Looks like a downtrend that has not changed. So until that starts to change, it's hard for me to get overly bullish of precious metals. I know some of you out there want me to be. You're dying for JC to be bullish of precious metals. I know you guys are out there. It's just I'm not there yet. I'm not there yet. But I will be, and I've been there before. So hang in there with me. Here we're looking at rare earth metals. Apparently they are not dead after all. I don't think I've said the word rare earth metals or the phrase rare earth metals in years. But I was looking through my sector charts and I was like, hey, look at that. We are now breaking out of downtrend line. So maybe it's not dead. I don't really have much to say on the rare earth metal space. If you want to do a little homework, go Go to REMX and look at the holdings. But it's interesting what's happening there. So definitely worth a look. All right, let's look at the currencies. This, especially if you're interested in precious metals, to me, the U.S. dollar index is a hot mess. This is me hungover after college 20 years ago on a Sunday morning, right? That's what this is. Hot mess. Now let's take a closer look, though. You guys, I mean, I came into last year, full disclosure, I was wrong. I came into last year talking about how we wanted to be selling dollars and buying gold. And part of the reason why we were so bullish of precious metals was because I thought the dollar was going to fall apart. And a dollar didn't go up, but it didn't fall apart either. It just did nothing. And here we are a year later, and I think it's now starting to fall apart finally. It took a lot longer. It took a year longer than I thought it was going to take, but here we are. Making new multi-month lows in the dollar index. Look at the UUP. This is the US dollar ETF, also putting in some nasty, nasty candles. So to me, if the dollar is going to fall apart, this seems like a logical place for it to do that. So let's take a couple of different looks at the dollar. Here's the trade-weighted US dollar index. And notice how we rallied into this level, 18 years ago, rallied into that level again a few years ago, rallied into it again in 2018, and last year tried to break out and now appears to be failing. So this isn't the traditional dollar index. This is the trade weighted. So this is the TWEXB. You can get it on Fred. This is a trade weighted US dollar index. Looks really vulnerable to me, particularly with that bearish momentum divergence. Let's look at a couple of individual names. Here's dollar versus Brazilian real. So this is the Brazilian real potentially starting a new rally in Brazilian real. Colombian peso potentially starting a new rally after failed breakdowns. Here we're looking at the Swedish krona potentially starting a new cyclical bull market relative to the dollar. And here we're looking at the Korean won. I mean, this looks like a massive top in the US dollar versus Korean won, potentially again starting out a new bear market in the US dollar Korean won, or a new bull market. Flip this chart upside down, and what that is Korean won breaking out. So meanwhile, look at Canadian dollar futures hitting new 52-week highs. And I've been talking about Aussie dollar the last several months, how I also think it put in its low. If Aussie's going up, CAD is going up, Korean won is going up, Brazilian real, all these names are doing well. That seems to me like a weak dollar environment to me. That seems to me like emerging markets are probably going to do pretty well in that environment. Here we took the other 9 G10 currencies and equally weighted them. And here's your list here. You got Kiwi, Aussie, Swissy, right? We got back down to those 2009 lows where we were a few years back, failed to hold those levels again, and now we're ripping. So here are the other 9 G10 currencies equally weighted. It looks to me like a squeeze is on, pushing up against new 52-week highs. And then what does that mean for those, some people are like, well, JC, I don't really care about currencies. How does that affect the stock market? Well, to me, if the dollar's falling here, this is the dollar in blue. Here we're looking at the S&P 500 versus EM. So if this chart in black is falling, that's emerging markets outperforming. So if you're looking for emerging markets outperforming, to me, this dollar weakness is really the catalyst to really get this chart going to the downside. So definitely want to keep on your radar for sure. We'll get to Europe in a minute, Kapil. But let's talk about a couple of. This is really interesting. First of all, when people are like, "Well, JC, we've been in a 10-year bull market," it's like, well, Taiwan's been doing nothing for 25 years, so I wouldn't call it a 10-year bull market. I would say we're just starting a new bull market after going nowhere for multiple decades in Taiwan. China hitting new 52-week highs as well. This is the China ETF FXI, and of course, we discussed earlier the Chinese internet stocks. Look at that candle today. Absolute monster. I think we're going to 56 in Chinese internet, and we'll go over some of the other countries in a minute. But I gotta believe things like Greece making new 52-week highs are just not evidence of risk aversion for equities. To me, it's evidence of risk appetite, and this, to me, has to be Exhibit A of risk appetite. These are frontier markets making new multi-year highs. And we're talking about an index that consists of Kuwait, Vietnam, Morocco, Nigeria. I mean, are these places where money wants to hide out because it's scared? I mean, these are like some of the, Kuwait, this is 37% Kuwait, and we're making new 52-week highs. So my argument is There's a lot of risk appetite out there, not risk aversion. A lot of financial advisors in the room. I get a lot of emails from you guys. I try to help you as much as I can. Of course, I get the growth versus value question all the time. And I'm sure at some point value will begin its outperformance, but that day is not today. At least we don't have any evidence that suggests that just yet. This is still an uptrend. And then also another important ratio that I think we need to watch is the high beta versus the low volatility index. We talked about it at the end of the summer, how we really need to start to see some strength out of the high beta names, particularly relative to low volatility, and we have started to see that. So if you think stock market's going higher, which I do, we still need to continue to see that rotation into the high beta names. So here's Europe making new 12-year highs, folks. 12-year highs for Europe. So whether you want to believe it or not, whether you like it or not, whether you agree with it or not, none of that is my problem. 12-year highs for the Euro Stoxx 50, by the way. And a lot of people are like, well, it's a currency thing. Well, Europe is making new 52-week highs priced in US dollars too. So it's not a currency thing. I don't want to hear it. Here we're looking at Europe hedged, right? So this is Europe priced in euro, making new all-time highs. So think about how many times we're saying the words Europe and high. And not like you have to be high to buy Europe. It's not like that. Like this is new 52-week high and new all-time high and Europe all in the same sentence multiple times. So think back at when was the last time you were able to say that with a straight face. Here are European banks breaking out of this downtrend. As far as I'm concerned, we want to continue to be buying European financials for sure. Here's the actual European bank index. This is the E1 FIN, making new 52-week highs price in US dollars. I still think that this is going higher. This to me is evidence of risk appetite for European equities for sure. Here we're looking at this is a European financials relative to the Euro Stoxx 50. To me, the squeeze is on. And if European banks are outperforming, which you can see in this chart, that tends to be very, very good for European equities. It's when European banks are underperforming that it's a heads up that something is wrong, similar to 2011, similar to 2014, 2015, similar to 2018 for that matter. And now we are getting breakouts in both Europe and in financials on a relative basis. So I get asked, well, JC, do we want to own Europe in euro? Do we want to own Europe in dollars? To me, I like them both. I don't really like to play that game too much. I think if we're going to own something, just own it. But for me, I like to use both of these as information, and I like both of them for sure. And then, by the way, just whenever in doubt, zoom out. This to me looks at 20 years of nothing, and now we are breaking out to new all-time highs. So I don't really know what there is to be bearish about this chart. If we're above all these former highs, I think I think I'm making a pretty solid argument that this is the beginning of a new bull market. I don't think that that's anything like earth-shattering or crazy. Like I'm not going to win a Nobel Prize for saying that this is the beginning of a new bull market. I mean, I think it's quite obvious. The only thing that would invalidate that thesis is for prices to get back below those former highs, right? And I think it's important to be aware that I have absolutely no idea what's going to happen next. But if we are above those highs, the path of least resistance is very much up. And to not be aggressively long, I think is irresponsible. So what's going to prove me wrong is if we're back under 400, we're back below those former highs. Fine, I was wrong. Sue me. I think, but I do think the much higher probability outcome, particularly with everything else we're seeing around the world, is that this is going much higher. Here's a closer look at the Euro Stoxx 600 breaking out of this monster base to new all-time highs, just to show you how important this resistance is. These are 2000 highs, these are 2007 highs, the 2015 highs, and we're through all of them. All of them. So, again, really hard for me to be bearish under those circumstances. Did you see Deutsche Bank today up 7%? If you don't find humor in Deutsche Bank going up 7% as European stocks are making new all-time highs, it's probably because you're not long enough. You're not long stocks enough. But I found it to be hysterical. I love a good short squeeze, and I think that's exactly what is happening. German DAX, what did I say? If we're above the 2015 highs, we have to be long. Stocks, got to be long European stocks, got to be long German stocks, got to be long stocks in general. My argument was that the world is not going to be coming to an end if German DAX is above the 2015 highs. It's just not happening. The world will come to an end with German DAX below. those 2015 highs. So here we are pushing up against new all-time highs. It reminds me a lot of the global Dow. It's a chart we want to be buying, not a chart that we want to be selling. Natalie bought Deutsche Bank last week. Good for you, Natalie. Kudos to you. Be careful with that thing because it moves. But look at France making new decade highs, really confirming what else we're seeing. Switzerland, if you guys recall, was the first one to break out. And my argument was this is the first one. It's not the only one that will break out, but this is a heads up that the other one's going to start to break out also, right? If you guys recall, that was my argument last year. And sure enough, we continue to make new all-time highs. Denmark is making new all-time highs, finally breaking out of this 3-year base. Sweden also breaking out of this base. These are all part of the European Union. Budapest making new all-time highs. Not exactly a flight to safety when the Budapest BUX index is breaking out of a multi-year base to new all-time highs. Estonia, also part of the European Union. To me, I think that this is going to be a successful retest of that former resistance, and Estonia is going higher. Same with Lithuania, successfully retesting that former resistance. So, that part of the world continues to shine. And even the worst part of the world, I say that respectfully. I love Italy. I married an Italian. I love Italian food. I'm obsessed with Italian wine. So no beef with Italy, but the stock market is a mess. And even the messy, garbage Italian, Milano Indice di Borsa, is pushing up against a new decade high. So even the worst of the worst, I think, is pretty impressive. We start to see the MIB above 25,000. Man, we're really off to the races. I think that's a really, really good sign for European equities, and I think that's a good sign for equities in general. Athens, I mean, this is the Greek stock market making new 5-year highs. Again, not exactly a place for a flight to safety, right? They're not buying Greek stocks because they think stocks are going to crash. They're buying Greek stocks because they're looking for that beta because the market's going higher. And I think that the Greek stock market has another 30-40% to go, which might sound like a lot, but for the Greek stock market, it's really nothing. So yeah, another 30-40% higher. Canadian stocks also making new all-time highs. Are you noticing how the list of new all-time highs keeps getting longer? It's not getting shorter. We call that expansion and participation. I think the Canadian TSX is going above 18,000. Here we're looking at stocks versus bonds. And notice how the ratio tried to break down and then quickly reversed. To me, further evidence that we want to be buying stocks and selling bonds. And then when you ask me, well, fine. What if I don't want to be buying stocks and I'm more of a gold and bonds guy? All right, well, I like gold over bonds, right? This to me looks like a smiley face any way you draw it up, gold versus bonds, right? So you can look at gold versus bonds like this, I want to buy it. You could look at gold versus bonds like this, I want to buy it. So I think everything is suggesting we want to continue to sell bonds. And that if we're selling bonds and we think bonds go a lot lower, that means rates are going a lot higher, right? And one of the areas I talk to a lot of people, I'm just not seeing the overwhelming amount of bullish, or bearish sentiment towards bonds, right? And people think that rates are going higher. Quite the opposite. Everybody thinks the rates are going to be stuck under 2.1, 2.2 at best. I think we'll be pushing 3 next year at some point. Until I see any evidence that suggests otherwise, I think we'll definitely be a year from now talking about the U.S. 10-year up here, not down here. But I guess we'll see. 207 is the big level. Once we're above 207, I could say with much more confidence that we're going to 250 and beyond. Right now, we're making the bet that we will break out in rates and break down in bonds. And I'll show you a couple of the bond charts now in a minute. But to me, rates are going higher. Here we're looking at copper versus gold. Here we're looking at regional banks versus REITs. And down here, we're looking at the 10-year yield. So in other words, the copper versus gold chart is what the commodities market thinks about interest rates. Regional banks versus REITs is what the stock market thinks about interest rates, and the US 10-year yield, obviously, what the bond market thinks about rates. To me, it looks like breakouts in copper, gold, breakouts in regional banks, REITs. I think US 10-year is next. So here we're looking at the US 10-year, 7 to 10-year Treasury bond fund, and it's selling off where you would figure it would sell off, right? Where it sold off in 2016, right? So nothing really too surprising. Bonds are selling off where they should. That seems like a pretty pretty normal sort of expectation from these levels, and I really do think it's just beginning, and bonds really could get hit harder. Here's a look at TLT, which is the most liquid bond ETF, also selling off from those former highs. 4 nasty candles in a row. This doesn't look good at all for bonds. I think that also points to higher interest rates. Here we're looking at the S&P 500 relative to bonds in blue, and just notice how well the stock market did when stocks broke out relative to bonds in 2013, how it did in 2016, and then once again what it's doing now, making new highs. So to me, this is further evidence that the stock market is breaking out, and it's just now starting its breakout, and we're closer to the beginning of a new bull market than we are near the end of an old one. Here are a couple of other stocks versus bond charts. Here's the NASDAQ versus bonds making new highs. Here's the NASDAQ bigger picture. This is the composite going back a couple of decades relative to 30-year futures. Excuse me, these are relative to 10-year futures. And, to me, new all-time highs. Again, further evidence that we're probably closer to the beginning than the end. And then when you ask me, well, JC, what does the stock market thinks about rates? Well, there's an ETF, EQRR, put it on your radar. It takes the highest stocks with the highest correlation to interest rates and groups them together. And notice how we made new lows in the US 10-year yield towards the end of the summer going into September. And we did not make new lows in the ProShares equity ETF. To me, the stock market's saying, hey, I'm not buying what the bond market's putting down, and we continue to put in higher lows in both. So an interesting one to watch for sure. And then if you ask me, well, JC, if interest rates are going up, they must be starting to price in some sort of inflationary forces, right? And that's precisely what the bond market is pricing in. We're getting breakouts in tips relative to US Treasury bonds. Same thing versus the IEF, which the duration is more equivalent to the tips. So for those of you who know, the tips are the inflation protected treasuries. The IEF is just a traditional treasury ETF. So when you compare the two, it's really how the bond market feels about inflation or lack of inflation over the last couple of years, as you can obviously tell. But things seem to be changing, which to me points towards higher commodity costs, points to higher interest rates. I think that's a bigger underlying theme that's taking place. Speaking of things that are not in uptrends, Bitcoin, for you masochists out there, it's just an absolute mess. Let's look a little closer. Listen, 7,400, if you have your heart set on being long, I would only be long if we're above 7,400. If you want to play that game and play this trade, to me, it's a mess. The path of least resistance is probably lower. If I had to, gun to my head, I think it goes to 4,600. But if we're above 7,400, obviously you can't be short. I actually like it long if we're above 7,400. So that's really the line in the sand, if you ask me. If we're above 7,400, I think we could see 12,000 or close to it. If we're below 7,400, I think you'll probably see 4,600 or worse. So that's really how I see Bitcoin. Ethereum, try to close your eyes and not look at this. This is not exactly something that we want to own. No, thank you. Same thing with Litecoin, absolute mess. Close your eyes if you have no interest. Just don't look at these charts. It's like when my father, when I was younger, I used to play baseball, and when I was a really bad hitter with a terrible swing, my father would make me close my eyes because he didn't want me to watch him swing, so I would pick up bad habits. So it's kind of like that. So just close your eyes. Don't pick up bad habits. These are not charts you want to be buying. You could probably still close your eyes, most of you, but for some of you who are interested in the marijuana stocks, I do think it's worth pointing out that the marijuana ETF is back down to those 2017 lows. So, and we have a little bit of a bullish momentum divergence. So if you have your heart set on it, and you really want to be long the pot stocks, this would be the place, right? And you want to give it a little room. Let's call it $8, right? If the HMMJ is above $8, let's be long the marijuana stocks, right? ACB, I like it if we're above 288, not below that, right? Because that would confirm a failed breakdown in bullish momentum divergence. If we're not above 288, can't be long. But if we are, listen, we're looking at prices above $5 most likely. Look at CanTrust Holdings, TRST. We got to be above 123. That's really my level. If we're above 123, I think we can own it all day long. This could be a 3-bagger, 4-bagger. These things have gotten absolutely destroyed. So if you're looking for a mean reversion, if we're above 123, CanTrust Holdings. What about Chrono, CRON? I like 1030. That's my level. If we're above 1030, fine. I like it long. Below that, it's a mess. So only above 1030. And especially with these pot stocks, these things are garbage. So we really want to make sure that we're disciplined with these levels. GW Pharmaceuticals, GWPH. For me, 92.50, right? That's where support was in 2017. Support again a little over a year ago, and that's where we are now. So 92.50. If we're above that, have a ball on the long side. So here's a breakout: KHRN, Kieran Life Sciences. If we're above a buck, these are not. A lot of these stocks, institutions can't touch them. Financial advisors can't touch them. But it is an asset class that I do get asked a lot about. So let's touch on at least some of the things. If you go to the chart book, allstarcharts.com/chartbook, there is a marijuana workbook in there with the pot stock. So I encourage you to go check that out. And then Neptune Wellness Solutions, NEPT, back down to the support. Listen, we found support here for 2 years, right? So if we're above 240, you want to take a shot, you could have, there could be a double here. The risk reward is skewed to the upside. I mean, that's just really what it is. Scott's Miracle, I'd wait for a breakout. 110 for me. If we're not above 110, I think is a waste of money. But above 110, I like it along with a target near 140. Zynerba Pharmaceuticals, ZYNE, I like it above 550, right? This has been a critical level in the past, 2016, 2017, even 2018. Here we are, 550, potentially a bullish momentum divergence. If we are not above 550, can't own it. But if we are, I like it with a target near 890. And then just finish up with a couple of charts that I think really kind of put the exclamation point on what I'm thinking here. Wilshire 5000, it may have nowhere near 5,000 stocks in it, but it is making new all-time highs. So it's not something that I want to be fighting. Here's another look at the global Dow. This is my favorite index in the world. This is a chart that we want to be buying, not a chart that we want to be selling. And bigger picture, look at the Dow Jones Industrial Average coming out of a 21-month base. No reason why we can't see 38,000 in the Dow Jones Industrial Average. It's not that much. It's not that high. I don't think we get there tomorrow, but I want you guys to think bigger picture in terms of what we're thinking here, and that's really where I think we're going. You guys who have been around for a long time remember this breakout in 2016 when we were under 20,000, and I was talking about 26,000, 27,000. Some of the people thought I was crazy. We got there pretty quickly. We got there in a couple of years. So I don't see why we can't see something very similar. And then I think this tells the story. This is the last chart I have. It was 100. I think I was like about 180 charts. So I think I overdid it a little this time, but I really did have a lot to say. So I hope I made my point okay. This is the top 10 countries in the world. These are the biggest 10 stock markets in the world, equally weighted. USA, Japan, India, UK, China, Hong Kong, Germany, Canada, Brazil, Australia, breaking out of a multi-year base to new all-time highs. What am I missing? Why are we not buying stocks? I can't think of a reason. We want to be looking for stocks to buy, not looking for stocks to sell. We'll have some more ideas in a few sector deep dives over the next few days. So look out for that. I know we didn't dive too deep. I mean, we dove deep into a few sectors, but we'll have some deeper breakdowns into some of the areas that have really started to show some outperformance. And if you guys have any questions at all, you know where to find me. Thank you, William, Stephen, Natalie, everybody. Thanks for being here. Jeff, everybody. Thanks again for being here. If I didn't get to your questions, please just email me info@allstarcharts.com and I will get to you right away. Thanks, everybody.